Okay, we're at 101, so we're going to go ahead and get started. We'd like to thank everybody for standing by and welcome to the AFS Best Practices weekly webinar. Our topic today is COVID-19 impact on commercial lending. Our webinar will be approximately an hour long, and I would like to introduce our first speaker today, Dean Snyder, Managing Director at AFS Vision. To enable open dialogue, we will be unmuting all lines after our prepared remarks. To help us manage those that would like to ask questions or make a comment, we ask that you use the raise hand feature, as you can see here, pictured on this slide. We will then see your hand raised and we will call on you. Additionally, you can use the Q&A feature to ask questions, direct your questions to the presenter, and we'll leave some time at the end of the presentation so that we may answer as many questions as possible. We are recording today's session, and tomorrow you will receive an email with a link to listen or download the presentation. Thank you for joining us today. Dean?
Thank you, Renee, and good afternoon to everyone. Again, please know that AFS hopes that everyone is doing their best to navigate through these very unique times. We're obviously now in a marathon and we all have to pace ourselves, be sure that we can finish this race very strong. We're hopeful that these series of webinars will be beneficial to you, and as always, we appreciate your input and feedback. We're scheduled to do these weekly through the month of April. So for today's agenda, we are going to have a review of the CARES Act as we know it, and then we wanted to talk about loan booking issues around the relief loans that are part of the CARES Act, and then continue our discussion from last week around deferments and forbearance changes to your existing portfolios. As we said last week, we have a list here of panelists from AFS that are set up to join in to help answer questions or participate as necessary. This is a small group of a large team at AFS that has been very focused on the COVID-19 situation for our clients. We've added today Lee Kidder, the director at AFS, who's going to take us through our first topic, which is a high-level review of the CARES Act and the key provisions that affect commercial lending. So, Lee, I am going to stop sharing, give you a chance to bring up your screen, and we'll hear from Lee for a few minutes and then take some questions before we move on to the next topic.
Okay, Dean, thanks very much. I hope everyone can hear me. I'm about to bring up some slides and put them into presentation mode so that we can get underway here. Okay, you all should see the slides now. I'd like to spend the next several minutes identifying what we at AFS see as the key provisions in the CARES Act that was enacted just last Friday that are going to be affecting commercial lending. This briefing is going to be able to cover only what's in the actual text of the Act itself. I can't really keep up with all of the furious activity and updates that have been proceeding from several quarters since then. There will be some updates that I just noticed in the past day or so that I can include. But the SBA website has been providing new information daily that's going to add guidance and instructions and clarification about the new small business loans program, which I'm going to be going over in just a minute. So let's get underway. I'm going to be going at a brisk pace because there's a lot of material to cover, but you at the client banks do have slides or will be receiving the slides, so you can at least catch up if I don't cover every particular point. The picture that's on this page came from the Wall Street Journal the day after the bill was enacted, and it provides the major segments of the bill, all of which together total of something over $2 trillion. I'm sorry. And what I'm going to be concentrating on today are those boxes in blue. that represent the two major segments of the Act that have to do with lending. One is in Title I, which covers the Paycheck Protection Program at the SBA. That's going to be authorized to spend up to $349 billion for that program. And the second program is the loan programs that are available to larger businesses that are going to be delivered through the auspices of the recently announced enhancements to the Federal Reserve's emergency lending program powers. So in Title I, this covers the Paycheck Protection Program. This, as I mentioned, authorizes $349 billion for this new program that's going to be delivered through Section A loan program at the SBA to small businesses, which by definition go up to 500 employees, to be able to cover most payroll and operating costs for those businesses for a period of time. These loans are going to be originated and dispersed by banks, but the loan program, as you probably know, does include a forgiveness feature by the SBA that I'll be getting to in just a minute. These loans are intended to allow businesses to cover costs that include most payroll categories, including healthcare benefits, insurance premiums, et cetera. And that they will be able to cover wages and other salary expenses up to an annual rate of $100,000 per employee. Employees that get paid over $100,000 will have their salaries included only up to $100,000. The program will also cover expenses for fixed operating costs like mortgage on buildings, any rents and utility payments that were pre-existing and occurring on a regular basis. I should note that for the borrowers of these loans, they can cover any state and local taxes that they pay, but federal taxes, including payroll taxes, are not going to be covered in this loan program. This next bullet says that the loans will be available immediately, but on the SBA website, there is an announcement that banks can start originating loans on this Friday, April 3rd. They're going to be originated through these 800 plus existing SBA lenders. But additionally, the Act allows an avenue for the SBA to approve other banks or lenders that are not authorized right now to make 7A loans to be able to do so. This could potentially, as I've seen in a couple of articles, permit fintech lenders to make loans under the PPP, the Paycheck Protection Program. Each loan is going to be equal to 250% of an employer's average monthly payroll. That has a maximum amount of $10 million for each loan. And banks will be able to originate these loans using what the SBA calls delegated authority. That is, they will not have to go through the usual underwriting requirements and rules that the SBA has in place for the 7A program, which should permit a quicker authorization and origination for loans. Lenders are also required to completely defer any payments on these loans for at least 6 months and potentially up to a year. Now we get the forgiveness program of these loans, and this is it can be quite complicated, so I've highlighted here only the major points of this issue. As long as any employer maintains its payroll and wage levels for at least for the first 8 weeks after getting a loan dispersed, then the portion of that loan that covers the expenses I mentioned on the previous slide, payroll and other utility and mortgage obligations, will be forgiven. Now, this forgiveness amount will be reduced to the percentage that FTE counts drop during the period, or if wage levels for any employee drop during the period below a specified percentage. That is to say, compared against the FTE levels last year in 2019 for the same period, If the FTE count for this year or during this program, say, falls to 85% of last year's FTE, then that reduction amount is going to be, it will not be allowed to be forgiven. The same with wage levels. To the extent that employee wages drop below a certain percentage, that reduction amount is also going to be removed from the forgiveness amount. In total, the amount that's forgiven for these loans cannot exceed the principal amount of the loan. That means that interest, any interest paid for these loans is not going to be forgiven. Now, the Act says that interest on the loans has to be at a maximum of 4%. But I just noticed last evening on the SBA website that they are telling banks that all loans are going to have an interest of 0.5%. and will have a maximum term maturity of 2 years. That's on the FCA website. Finally, any forgiveness amount for employers will not be considered a taxable income for their federal tax returns for the subsequent year, so they won't be getting to 1099 or other documents. The SBA will refund or remit to banks the amount forgiven for any loans not later than 90 days, after which that forgiveness is determined. And in addition, there's going to be a processing fee that the SBA will reimburse for banks. For loans up to $350,000, that fee will be 5%, 3% for loans above $350,000 but below $2 million. There's a typo there, I just noticed. And 1% for any loans over $2 million. These reimbursements, according to the Act, will be dispersed from the SBA to the banks within 5 days after the original disbursement of the loan. Now, after the loans are forgiven, if there's any amount left over for that loan, there will be a maximum maturity period of 10 years for those amounts. Now, the SBA is required by the Act to issue any additional regulatory guidance on the program within 30 days. As I mentioned, they have already started to do so on their website, and I expect that will be forthcoming on a daily basis. Now, in addition to the PPP, the Paycheck Protection Program, Congress recently enacted, just a few weeks before the CARES Act, a new program at the SBA called the Emergency Economic Injury Disaster Loans. These loans are available for businesses, again, up to 500 employees and others. These loans will be originated and approved on a short-term, a rapid-fire, quick basis. The terms do not require the original approval notice that the SBA has for such firms. And it will be available for businesses that were in operation in January of this year. The SBA can approve them just simply based on a credit score or other available method, and they will not require tax return or tax transcripts for them. Now, the interesting feature that the CARES Act added to this program is that any borrowers that are in the process of applying for an EIDL, an Economic Injury Disaster Loan, can also request a grant of up to $10,000 as an advance on that loan, and that grant, if approved, is not going to be required to be repaid. So this program, as I've read, is really an alternative or another opportunity for banks to get disaster relief from the SBA. Businesses that do have these loans already or are in the process of applying for them will be able, in addition, to get a PPP loan as well, or be able to transfer their EIDL loan grant into the PPP program. So that transition should be fairly smooth and easy. Now, finally, where SBA loans are concerned, there is another provision for businesses that are currently have existing conventional 7A loans. The SBA will be paying the principal, interest, and any fees for these existing loans for a 6-month period for these existing borrowers. And finally is the note that loans under the new PPP program are not considered covered loans for this particular subsidy feature. Now we come to the second major portion of this act that gets into loan programs and facilities for larger businesses. You may have noticed in the past several days or a couple of weeks that the Federal Reserve has been announcing a series of new facilities that are available to provide liquidity for major market segments, the credit and securities markets. They have facilities that are enabling them to purchase commercial paper, to guarantee money market funds, and to get into the corporate bond market and primary dealers in securities. These are facilities that enable the Fed to inject money into the financial environment for the purpose of a lot of these direct loans. Now, these are available to businesses that are larger than 500 employees, and there's an interesting provision in the Act as well that said that says, and I quote, "The Secretary," and this is the Secretary of the Treasury, "shall endeavor to seek the implementation of a program providing financing for banks for direct loans to mid-sized businesses." Mid-sized in this case means 500 to 10,000 employees. And the loans that are mentioned in this segment are projected to be issued at a rate of 2% with a 6-month payment deferral. As I said, that particular provision amounts to what's called a sense of the Senate Act in legislation, and simply means that it is the wish of the legislation that the Secretary try to set up a program geared specifically towards smaller businesses. As you can see here, there are provisions that do provide direct lending to specific industries or businesses, particularly air carriers, the airlines, and businesses that are associated with them, businesses that are important to maintaining national security. These provide direct loans to those businesses. Now, this particular program really for the first time breaks a traditional taboo at the Federal Reserve, and that is allowing it to make direct loans to businesses, which it has not done beforehand, except in very, very specific cases. Finally, the feature that we're concerned with is the $454 billion, which is going to be available under these new lending facilities and the specific emergency lending authority provided by the Federal Reserve Act, Section 13(3). That is a tool that was used during the financial crisis a dozen years ago, and it is being revived now to authorize the Fed to make these programs and facilities available under what that section calls unusual and exigent circumstances. So loans that are available under these criteria have some strings attached to them. And I'll get to those in just a second. The loans are going to be available through December 31st of this year. They will not exceed 5 years in maturity, and as distinguished from the PPP loans for small businesses, these loans to larger businesses are not going to be forgivable. Now, the strings that I mentioned include a number of features as follows. The borrower or the business that's getting the loan has to certify that it is US domiciled and that its employees are predominantly located in the US. Businesses that receive these loans will not be able to engage in stock buybacks or pay dividends until at least 1 year after the loan is no longer outstanding. Additionally, there are going to be limitations for total compensation for certain officers and employees of these businesses, which has quite a bit of detail in the Act about them. The figure that I believe is the threshold for what's considered highly paid compensation is $425,000. And finally, businesses that receive these loans are going to have to certify and pledge that until September 30 of this year, they will maintain the employment levels that they had as of right now, and to the extent possible, keep at least 90% of that level of employees in September. The Treasury Secretary is required to publish any application procedures, minimum requirements, and other information about these loans no later than 10 days after enactment, which by my calendar means April 6th, next Monday. And finally, there are a couple of interesting features that were included in the Act that are not particularly relevant to these programs, but I wanted to mention them as well. Any loans that are modified under these programs will not be required to be reclassified as a troubled debt restructuring under accounting rules. And the CECL program that the FASB has promulgated has been delayed. According to the Act, it's delayed until either the end of the national emergency or December 31st, whichever comes earlier. And you may have seen that a few days ago, the Fed and other regulators issued an interim final rule that allows banks to delay the impact on regulatory capital of CECL by up to 2 years. So that covers the major terms of the Act. If you have any questions, you can please submit them, and I'm going to turn it back to Dean to continue with the other portion of our webinar here. Dean?
Thank you, Lee. Appreciate that overview. We're going to get into talking about the dealing with these loans and the booking of these loans, and we can entertain questions as well at the time. Here we go. So to not state the obvious, but I think banks are expecting there's going to be extremely high volume of new loans that are going to need to be booked because of the Relief Act. And we have some questions, and one is for the banks, are these mostly going to be loans to existing customers or obligors, or will you be creating new ones? That certainly changes the workload if you are just booking obligations and you already have an existing obligor customer to do this under. Again, looking for some feedback from our clients to see what you think. You're certainly going to need to be able to mark these loans in some way. We've heard from clients about using, obligation type, purpose code, or other fields that are in AFS that are in both Level 3 and AFS Vision. There are several different options out there as to how you can tag loans. Auditing is going to be, I think, an extremely important part of this process because there's going to be a large volume. There's going to be a lot of interaction between the banks and the SBA, or the banks and the Fed or Treasury. You're going to have to be able to, I think, show proper audit trails, so forth, of all the activity that is occurring under the Relief Act. Now, to deal with the high volume, we've been looking at that here at AFS in terms of, is there some way to provide some new form of automation for this? And for those clients who are now in AFS Vision, we do have what we call a mass update tool that we can leverage to help create a more efficient way of booking loans. This is going to bypass a lot of your standard process and underwriting and so forth, but it's an answer to how can you deal with a very large volume of new obligations that need to get created. And this mass update tool can take data from something like an Excel spreadsheet and translate that into building obligations. On the AFS Level 3 side, certainly you know that in Level 3, it has always supported the ability to load data through batch cards. And so I know our banks to certain degrees or different degrees have utilized this process but it's a matter of then mapping the data over to the patch card so that you can automatically update or create new obligations, new records in level 3. I know some clients have used some I'll call screen scraping tools like Foxtrot or something. So it's a possibility you may already be looking at these options as a way. And then lastly, you know that there is a tool in level 3 called Auditing, and that tool can possibly be leveraged by AFS. I apologize if I'm getting some feedback here. Hold on. If that's better. Renee, can you still hear me?
Yes, I can hear you. Still a little bit of an echo though.
Yeah, I don't know where that's coming from. I apologize. But the Auditing hybrid is something that AFS could work with each client individually to develop as a possible solution. It's going to take some time to do that, but again, we're offering that as an idea depending on what the interest is on each client. Also, for those that are running level 3, of course, the manual booking options, there is in level 3 a short form create transaction. There's also something that I'm not sure too many banks are using called product definition. It was actually created for us to deal with some more retail consumer type loans. Gives you the ability to define certain attributes around the obligation and then use a 13AA screen, which requires very minimal data to get that obligation built because it's going to follow the template that you created in product def. So those are some of the things we've been dealing with in terms of ways to support the influx of new loans. I'm going to ask Renee if we have any questions or anyone wants to share anything from their side.
Yes, actually, at this point, we don't have any questions. And if anybody, we've been unmuting lines as we go here. So if you do have a question or a comment you'd like to share, please raise your hand. It'll make it a little easier for us to identify you. I don't see anyone, Dean.
Okay. That's fine. And again, we've been approached by different clients, and you can continue to reach out to us, AFS, individually, so that we can discuss with you and offer other additional support options for you. We did have questions last week around the loan deferments and forbearance. We talked quite a bit last week about the ability to make billing adjustments or extending loan terms and so forth in AFS, both level 3 and AFS Vision. We've continued to have conversations with clients around these changes. One of the recent developments we're hearing about is if you are deferring your billing, is what is your general ledger treatment going to be? Because it looks like banks are considering the interest during the deferment period that they want to be able to classify that differently in general ledger. Now there's different ways to do that in AFS, short of changing a general ledger code on the loan. But if you have to track certain amounts of interest, that could include setting up a separate interest charge code where you could track interest during the forbearance period or deferral period. And then the question is, how do you recover that interest? Can that, in some cases, and we're hearing that just gets deferred until the maturity of the loan, or does the bank want to be able to recover that interest in a shorter period of time? Certainly creating different charge codes, while we recognize that that's more work in the servicing side, it does give you the cleaner accounting that the finance department might be looking for. Also around past due calculations, we touched on this before. What we're seeing in the regulations is that basically the borrower is going to be deferred payments, so they're not going to go more past due during the period. But if they were past due entering into the Relief Act period, it sounds like what the regulators are saying is the borrower stays in that past due status, but does not continue to get more past due. So if they were 30 days past due when they started the deferment period, for those 3 months or 6 months, whatever that period is, they would continue to be considered 30 days past due. They would not keep getting another month as time goes by. And then the question is picking that up at the end of the deferred period, and then you start counting past due days again. For credit bureau reporting, I understand I think there have been some guidelines issued. There's a certain code, I think, for credit bureau around, I think it's an AW code for affected by natural disaster. And it sounds like the bureaus are advocating using that code to tag these loans during the deferment period. In terms of marking the deferrals, again, there's different fields in AFS, being able to report on them. Certainly if you use different charge codes, that gives you automatic reporting options. From an auditing standpoint, you have your complete audit trails in AFS. So you're going to have a full record of all changes that are being made that would then be available for whatever requirements or the regulator might have. We've been putting together some job aids for certain scenarios. If you're looking for some guidance, AFS can provide that for you. We've had a couple of clients that have put together their own internal procedures and asked us to take a review of those, so AFS can help in that way. Again, we're looking for ways that we can be supportive to what you all are trying to deal with. Any questions on any of these topics, or does anybody want to share what your institution is currently doing or possibly considering doing, both around loan deferments and forbearance, but also around the booking of the relief loans? You can feel free to jump into the conversation if you like.
Dean, we have Molly has a question.
Hi, Molly.
Hey, Dean. So I did want to bring up the credit bureau reporting. Equifax told me this week that they're working on a new status code of 2021 and 22, and they're supposed to send out guidance on that by the end of the week. I didn't know if you had heard anything about that.
Let me ask Paul and your team, have you heard anything about the Equifax codes?
Yeah, and I did follow up with DNB, and they indicated that would be sufficient for them too. So they were talking about using those statuses, continuing to report loans, but using those statuses.
Okay, thanks.
No, Dean, I'm sorry, Dean. No, we had not heard that. Particularly what we had heard was to use the AW to indicate natural disaster. But if they're going to be issuing a new status code, that's fine as well.
Okay, and then I had a question on the past due calculation. What did you suggest? We just started down the discussion on the past dues and freezing them. How are you suggesting that we do that?
I don't, Paul, I'll ask you first. I'm not sure we've come up with a way to freeze the past dues. So is that right, Paul?
Yeah, that's right. I mean, there's, within level 3, we're looking, the aging process is looking at the amounts that have been billed and not paid, and aging those back over existing invoices to arrive at the oldest unpaid invoice date. And, that's done every night. So,
Right.
Each night we're going to add 1 to the number of days because that oldest invoice that's out there it hasn't been changed. So, one, and then the other aspect, of course, is when it comes out, or even during that period, during that deferral period, what happens if you have payments or reversals within that? Do you change your past due counters at that point, or your days, because that payment or reversal could either increase or decrease the number of days past due that may have been what it was going into the deferral period. And then coming out of it, of course, is, when do you start counting again? And that oldest unpaid invoice is still out there. So if you're 60 days past due going in to the deferral period, and let's say you freeze them for 3 months, when you come out and you start counting again, that oldest invoice is now 150 days past due. Does he jump from 60 to 150 days right away? And we haven't figured out how that would be addressed, nor what the rules are going to be around it.
Yeah, so we have that on our list to continue to look at, Molly, and see what we can come up with at AFS. So we'll stay in touch with you and anybody else from any other banks. If you're interested in that topic, let us know. That could very easily spin off into kind of a separate subgroup that could continue to look at that.
Okay, that would be great. And then you talked about the 3 different programs. We are in depth in the PPP program right now, and we are considering it only for current customers, deposit or loan customers. But you talked about the other 2 programs. Is that money coming directly from the government? Or are you saying those other 2 programs are funded through the banks too?
Lee, I'm going to let you answer that.
Molly, hi. My understanding is that those are going to be applications that are sent directly from businesses to the SBA. I'm not aware that banks are going to be involved in them, but I could be wrong.
Okay, great. Thank you.
Because one of those programs is, as I mentioned, barely 2 weeks older than the CARES Act. If you go to the SBA website, there is a button on there to apply for an EIDL grant.
Okay, great. Thanks. Okay, thank you.
Dean,
We had another question about, yeah, I got it, Renee.
Okay, great.
About booking, possibly using robotics or RPA into level 3. Does anybody want to share if they're exploring that option, how they might be doing that? Again, this is just for the benefit of the other clients, if you'd like to share that. I think that might be, along the lines of like a Foxtrot or some tool like that, where you've got to get the data from, however you're going to collect it from the borrower, right? And then it's possible robotics could translate that data into whatever input tool you're using then to update level 3. I think that's our understanding. Does that make sense to you, Paul?
So Dean, we use a lot of robotics in the bank, but for this, we're talking about the Foxtrot program where we're going to get data directly out of potentially a fintech that we use and take that data and Foxtrot it into AFS through screen. It's basically a macro type tool.
Okay. That's good. The other thing that I was in a conversation last night with one of our clients is, unfortunately, they were asking about fraud prevention. And again, I can just throw that out there. But unfortunately, I guess we know that whenever some situation occurs like this, there's always going to be people who try to take advantage of that. Hopefully, it's a very small group, because I know the interest of the government, of course, is to get the money to the borrowers as quickly and easily as possible. And so trying to figure out what documentation and how you prevent fraudulent applications. I don't know if anyone has been looking at that yet, or if they have anything they want to share of what their institution is thinking about. Or maybe I just gave you all something to start thinking about. Okay. What else? Yeah, go ahead.
Yeah, we have it's Renee. We have a question here about the OFD transaction. The 7332 offset does not have the 370 TRAN type captured. How do we capture that?
Oh, wow. Paul, that's obviously your question. That's getting real detailed.
I thought it was. I did chat with him.
Paul, you might be on mute. If he might be having technical issues, we can follow up. Do we have the name of that person, Renee?
Yes, we do.
Okay, so we will follow up with you specifically with that question. Again, we're looking for input for other things that we can be doing. We will continue to do these on a weekly basis. So next Wednesday, April 8th, which unfortunately all day today, I thought today was April 8th. I wish we could accelerate the calendar that way in some ways, but again, AFS is here to help and let us know questions, ideas, suggestions, whatever that might be. We will look forward to working with each of you as best we can. So thank you everybody for your time today. Appreciate that. And we'll be speaking next week. Thank you. Thanks, Renee.
Thank you. Have a good day, everybody.